Queensland has been the star performer of Australian property over the past 5 years. Brisbane's median house price has grown 68% since 2020. The Gold Coast is up 72%. The Sunshine Coast is up 84%. Regional Queensland towns have seen gains of 60% to 100%. Everyone wants to know, is Queensland still a good investment? Have the best gains already happened? Where are the opportunities now? And most importantly, where should you actually put your money? I'm going to break down everything you need to know about investing in Queensland property in 2025 and beyond. By the end, you'll understand which Queensland markets still offer opportunity, which ones have already peaked, what risks you need to watch for, and exactly where the smart money is going. Let's start with why Queensland has been so strong and whether that strength will continue. Why Queensland boomed. The driving forces. Queensland's property boom wasn't random. It was driven by specific, identifiable factors that created exceptional conditions. Interstate migration, the game changer. The primary driver was massive interstate migration. From 2020 to 2024, over 250,000 people moved to Queensland from other states, predominantly from New South Wales and Victoria. Why? Multiple reasons. COVID lockdowns made people reconsider where they lived. Melbourne's extended lockdowns pushed people to Queensland's openness. Remote work became normalized, allowing people to live anywhere. Queensland offered better weather, lower density, and significantly cheaper property than Sydney or Melbourne. A Sydney family selling a house at $1.5 million could buy a $900,000 Brisbane house, bank $600,000, and enjoy better weather. That value proposition was irresistible to tens of thousands of families. This migration created enormous demand pressure. Every person moving to Queensland needed somewhere to live. This demand hit a housing market with limited supply, pushing prices up dramatically. The 2032 Olympics, the long-term driver. Brisbane was awarded the 2032 Olympics in 2021. This isn't just a 2-week event. It's a decade-long infrastructure and investment boom. The Queensland government is spending over $7 billion on Olympics venues and infrastructure. Cross River Rail, $7 billion, new metro lines, stadium upgrades, urban renewal projects, all driven by Olympics preparation. This infrastructure investment is transforming Brisbane's connectivity and amenity. Suburbs that were poorly connected are getting world-class transport. Areas that were industrial are being redeveloped into mixed-use precincts. Infrastructure drives long-term property value. The Olympics infrastructure will support Brisbane property for the next 20-plus years, not just through 2032. Affordability relative to Sydney and Melbourne. In 2020, Brisbane's median house price was $550,000. Sydney's was $1.1 million. Melbourne's was $850,000. Brisbane offered genuine affordability compared to southern capitals. Even after the boom, Brisbane at $1.04 million is still more affordable than Sydney at $1.7 million for what you get. Investors and owner-occupiers could access better properties for less money in Brisbane. This value proposition continues to attract buyers, though the gap has narrowed significantly. Strong economic growth. Queensland's economy has been strong. Employment growth outpaced other states. Major projects in mining, LNG, renewable energy, and infrastructure created jobs. Tourism recovered strongly post-COVID. Brisbane's economy is diversifying beyond mining and tourism into technology, education, healthcare, and professional services. This economic strength supports property demand. Where Queensland stands now. The current reality. That was then. What about now, in 2025? The boom has moderated. Brisbane's explosive growth has slowed. Growth rates that were 20+% in 2021-2022 have moderated to 5 to 6% in 2025. This is healthy. Explosive growth isn't sustainable. Moderate growth is. Interstate migration has slowed from its peak but remains elevated. People are still moving to Queensland, just not at the frantic pace of 2021 to 2023. Brisbane is no longer the cheap alternative. At $1.04 million median, it's expensive. The value proposition has changed from amazing value to decent value relative to Sydney. Affordability constraints are biting. Brisbane buyers are increasingly stretched. First-home buyers struggle with $200,000 plus deposits. Investors face lower yields as prices have risen faster than rents. This affordability constraint will moderate future growth. The pool of buyers who can afford Brisbane is smaller than it was when prices were $550,000. Different markets are performing differently. Queensland isn't monolithic. Brisbane performs differently than the Gold Coast. Regional mining towns perform differently than coastal lifestyle towns. Some Queensland markets have run too hard and are vulnerable. Others still offer genuine opportunity. Understanding these differences is crucial. The best Queensland investment locations right now. Let's break down where opportunity still exists in Queensland. Brisbane. Selective opportunities. Brisbane as a whole has already had its boom, but specific areas still offer growth potential. Inner South. The Olympics play. Suburbs around Olympics infrastructure and venues. Woolloongabba, South Brisbane, Dutton Park, Annerley. Why? These suburbs are being transformed by Cross River Rail and Olympics investment. Woolloongabba is getting the main stadium and a major station. The entire precinct is being redeveloped. Prices: $700,000 to $900,000 for older houses, $500,000 to $700,000 for apartments. Expected growth: 5 to 7% annually through 2032 as infrastructure is delivered. Risk: already priced in some Olympics premium. Not cheap. Middle ring gentrification suburbs. Suburbs 8 to 12 kilometers from CBD that are gentrifying. Moorooka, Salisbury, Rocklea in the south. Stafford, Kedron, Chermside in the north. Why? These suburbs are being discovered by buyers priced out of inner suburbs. They're getting infrastructure upgrades and retail development. Buyer demographics are shifting younger and wealthier. Prices: $650,000 to $850,000 for houses. Expected growth: 5 to 6% annually as gentrification continues. Risk: slower growth than Olympics areas. Requires patience. Logan, the value play. Logan has been overlooked despite proximity to Brisbane. Suburbs like Logan Central, Springwood, Shaler Park. Why? Logan is 20 to 25 kilometers from Brisbane CBD with improving transport links. It's significantly cheaper than Brisbane proper. Major infrastructure investment coming. Demographics improving. Prices: $500,000 to $700,000 for houses. Expected growth: 6 to 8% annually if infrastructure delivers and demographics continue improving. Risk: historically lower socioeconomic area. Stigma may persist. Higher vacancy risk. What to avoid in Brisbane? Brisbane CBD apartments, massive oversupply from 2015 to 2020 construction boom. Weak fundamentals. Yields and capital growth are both poor. Outer growth corridors with huge supply. Areas like Springfield, North Lakes have enormous new supply coming. This will moderate price growth significantly. Already expensive inner suburbs. Suburbs like Ascot, Hamilton, New Farm are already at premium prices, $1.5 to $2 million plus. Limited growth upside from these levels. Gold Coast, the lifestyle premium. The Gold Coast has performed exceptionally, up 72% over 5 years. It's now expensive at a median of around $1 million. Where opportunity exists: northern suburbs, Coomera or Mayo, Pimpama. These benefit from improving infrastructure and are more affordable than central Gold Coast. Prices: $650,000 to $850,000 for houses. Expected growth: 4 to 5% annually, moderate but steady. Robina and inland suburbs, more affordable than beachside, benefit from town center development and infrastructure. Prices: $750,000 to $950,000. Expected growth, 4 to 5% annually, moderate but steady. What to avoid on Gold Coast? Surfers' Paradise Apartments. Oversupplied, highly cyclical, dependent on tourism. Yields can be okay, 4 to 5%, but capital growth is weak. Premium beachside suburbs, Burleigh, Mermaid Beach, Broad Beach, are already at $1.5 to $2 million plus for houses. Limited growth upside. You're paying for lifestyle, not investment returns. Gold Coast verdict. Gold Coast is transitioning from growth market to stable market. Still livable and attractive, but the explosive growth is over. Suitable for lifestyle seekers and stable long-term holds, not for growth-focused investors. Sunshine Coast, expensive but stable. The Sunshine Coast is now very expensive, median around $1.1 million. It's had an 84% gain over 5 years. Limited investment upside. The Sunshine Coast has become lifestyle destination for retirees and sea changers. Properties are expensive relative to rental yields, typically 3 to 4%. For investors, the math doesn't work well. You're buying expensive properties with low yields. Capital growth will be moderate, 3 to 4% annually, because affordability is already stretched. Sunshine Coast verdict. Great place to live if you can afford it. Poor investment proposition unless you're wealthy and want a holiday home that might appreciate modestly. Townsville, the yield play. Townsville is Queensland's best yield market for investors. Why Townsville works? Stable defense employment. Townsville has a major defense base providing stable employment and population. University presence. James Cook University provides student rental demand. Mining services. Townsville services nearby mines, providing economic diversity. Affordable prices. $450,000 to $600,000 for houses. Strong yields, 5 to 6% gross rental yields, which is excellent. Expected performance. Capital growth, 3 to 4% annually, moderate but steady. Yield, 5 to 6%, which is excellent. Total returns, 8 to 10% annually, yield plus growth, which is strong. Risks, economic dependence, vulnerable if defense spending cuts or mining slows. Cyclical, has experienced booms and busts historically. Distance, far from southeast Queensland, limited interstate buyer appeal. Townsville verdict, excellent for yield-focused investors who need cash flow. Moderate growth but strong income. Best risk-adjusted yield market in Queensland. Cairns, tourism-dependent risk. Cairns offers decent yields, 5 to 6%, but is highly dependent on tourism. Why Cairns is risky? Single industry dependence. Tourism is 80+% of the economy. When tourism suffers, COVID, economic downturns, travel restrictions, Cairns suffers. International exposure. Heavily dependent on international tourists. When borders close or exchange rates shift, demand falls. Cyclical employment. Tourism employment is seasonal and insecure. Cairns verdict. Only for investors comfortable with cyclical risk and who believe tourism will remain strong. If tourism stays robust, returns can be good, 6 to 8% total returns. If tourism weakens, capital values can fall 10 to 20%. Regional Queensland mining towns. High risk, high reward. Towns like Mackay, Gladstone, Rockhampton are mining dependent. The boom-bust cycle. These towns boom when commodity prices are high and mines are hiring. They bust when prices fall and mines close. Mackay boomed when coal prices were high. Prices rose 50% plus in 2 years. Then coal prices fell and Mackay prices dropped 20%. When it works. If you can time the cycle, buy early in the boom, sell before the bust, returns can be exceptional. Yields of 6 to 8% plus capital gains of 30 to 50% in boom years. When it doesn't work? If you buy at the peak of the boom, you'll watch prices fall 20 to 40% and take years to recover. Rents fall, vacancies rise, and you're losing money every month. Regional mining verdict. Only for sophisticated investors who understand commodity cycles and can time entries and exits. Not suitable for buy-and-hold investors or anyone who can't afford to lose money. Toowoomba, the underrated regional city. Toowoomba is Queensland's largest inland city with a diversified economy. Why Toowoomba works? Real economy, education, agriculture, logistics, healthcare, not dependent on single industry. Strategic location, inland hub between Brisbane and Western Queensland, benefits from freight and logistics. Affordability, $500,000 to $700,000 for houses. Stable demand, consistent rental demand from students, workers, and families. Expected performance, capital growth, 4 to 5% annually, solid and sustainable. Yield, 4.5 to 5.5%, decent. Total returns, 8.5 to 10.5% annually. Toowoomba verdict, underrated, offers good risk-adjusted returns for investors seeking diversification outside coastal markets. Not exciting, but solid fundamentals. Queensland investment strategies for different investors. Different investor types should approach Queensland differently. Strategy 1. Growth-focused investor. If you're prioritizing capital growth over yield, the best approach is focus on Brisbane's inner south and middle ring gentrification suburbs. Accept lower yields, 3.5 to 4.5%, for better growth potential, 5 to 7% annually. Portfolio: 60% Brisbane inner south, Olympics infrastructure suburbs. 40% Brisbane middle ring gentrification suburbs, Moroka, Stafford, Salisbury. Time horizon, 7 to 10 years to capture Olympics infrastructure benefits. Strategy 2. Yield-focused investor. If you're prioritizing income over growth, the best approach is focus on Townsville and Toowoomba. Target properties with 5 to 6% yields. Portfolio: 50% Townsville, defense employment stability. 30% Toowoomba, diversified economy. 20% regional Queensland non-mining town, example, Bundaberg, Maryborough. Time horizon, 10+ years for steady income stream. Strategy 3. Balanced investor. If you want both growth and yield, the best approach is to diversify across Brisbane and regional. Portfolio: 40% Brisbane selective suburbs, moderate growth, moderate yield. 30% Townsville, high yield, moderate growth. 30% Logan or outer Brisbane, growth potential with reasonable yield. Time horizon, 10+ years. Strategy 4. High-risk investor. If you're comfortable with risk for higher potential returns, the best approach is mining exposure and Olympic speculation. Portfolio: 50% Mackay or Gladstone, mining cycle timing. 50% Brisbane Olympics precincts, infrastructure speculation. Time horizon, 3 to 5 years, active management required. Warning: this strategy requires expertise and active monitoring. Not suitable for passive investors. Queensland investment risks you must understand. Queensland property isn't risk-free. Several factors could derail performance. Risk 1. Affordability constraints. Brisbane is now expensive. Further price growth requires wage growth or further rate cuts. If wages stagnate or rates stay elevated, growth will be limited. Risk 2. Interstate migration reversal. If remote work reverses and companies require office attendance, interstate migration to Queensland could slow or reverse. This would reduce demand significantly. Risk 3. Oversupply in apartments. Brisbane and Gold Coast have significant apartment supply in pipelines. This could create localized oversupply, particularly in CBD areas. Risk 4. Natural disasters. Queensland faces flood risk. Brisbane 2011-2022, cyclone risk, far north, and bushfire risk, western areas. Climate change is increasing frequency and severity. Insurance costs are rising significantly in high-risk areas. Risk 5. Economic dependence. Queensland's economy is still heavily dependent on mining and tourism. If China's demand for commodities weakens or global tourism declines, Queensland's economy suffers. Risk 6. Olympics disappointment. If Olympics infrastructure is delayed, over budget, or doesn't deliver expected benefits, Olympics adjacent properties could underperform expectations. Tax considerations for Queensland investors. Queensland's tax environment is relatively favorable compared to some states. Land tax. Queensland has moderate land tax. Threshold is $600,000, meaning properties worth less than that incur no land tax. Rates increase progressively above that threshold, much more favorable than Victoria. Stamp duty. Queensland's stamp duty is around 3.5 to 4.5% of property value, moderate compared to other states. Some first home buyer concessions available. Foreign buyer surcharge. 8% additional stamp duty for foreign buyers, plus 2% annual surcharge. This reduces foreign buyer competition. Overall, Queensland's tax environment is investment-friendly compared to Victoria or NWS. The bottom line, is Queensland still a good investment? Queensland remains a reasonable investment location in 2025, but with important caveats. The best gains have already happened. The explosive 60 to 100% growth of 2020 to 2024 won't repeat in 2025 to 2030. Expect moderate growth of 4 to 6% annual in most markets. Location selection is crucial. Brisbane's inner south and selective middle ring suburbs offer better prospects than outer suburbs or Gold Coast lifestyle areas. Yield markets remain attractive. Townsville and Toowoomba offer strong yields, 5 to 6%, with moderate growth. For income-focused investors, these are excellent. Risk has increased. Prices are higher, yields are lower, and affordability constraints are biting. The margin for error is smaller than it was in 2020. Queensland isn't monolithic. Different markets have vastly different risk-return profiles. Mining towns are high risk. Townsville is low risk. Brisbane Inner South is moderate risk with good upside. For investors entering Queensland now, the approach should be focus on fundamentals, infrastructure, employment, demographics. Accept moderate returns, 6 to 8% total returns annually. Diversify across multiple locations. Hold long-term, 10 years plus. Avoid chasing last year's winners, Gold Coast, Sunshine Coast. Queensland's best days of extraordinary returns are behind it, but reasonable returns in a growing state with strong fundamentals remain achievable for disciplined investors who choose carefully. The opportunity has shifted from buy almost anywhere in Queensland to buy in the right places in Queensland. That requires more research, more discipline, and more patience. But for investors willing to do that work, Queensland still offers solid opportunities.